Hi, good morning, everyone, and welcome to a Thursday takeaway. Obviously, in these segments, we look at the major news and data points coming out on a month-over-month basis. We have a major entity cutting forecast for global economic growth. I also want to talk about the latest on the inflation data that just came in as of today. And then, of course, I always like to prove myself right. And we're talking about used cars and how we kind of predicted that this was kind of the beginning of prices coming down? And will the Fed change or alter its course regarding interest rates? Will they raise it? Will they pause it? Will they slow down? I have arguments from both sides. So let's dive into it. And we'll start off with our first article from Bloomberg regarding the World Bank. So the World Bank cut its forecast for 2023 and even into 2024. And they gave a couple reasons why. One, inflation, interest rates, you got war, and then you got debt risk. And we'll talk a little bit about the debt risk from an investment standpoint. Talk about these zombie companies, but we'll just dive a little bit deeper into what the World Bank said. So the World Bank slashed its growth forecast for most countries and the regions and warned of new adverse shock that could tip the global economy into a recession. And this new adverse shock is that they're hinting at has to do with how our economy functions. And if you understand how the United States functions, we are a debt-based economy, meaning we make money off of money, spending money, going into debt, and then so on. So what happens when all of a sudden rates go up so fast and drastically? It makes debt not exciting. It's not a very incentive. The rates are too high and people don't want to do it. But what the problem is, it has to lead to investments. And in certain companies, like I'll give an example, there's certain companies that maybe have IPO'd who are not yet profitable and are relying on investments from investors to keep up their books and make sure they don't run out of business. But what happens if all of a sudden that stops? What are we going to see? We're going to see a lot of zombie companies go out of business. So when we're in a debt-based economy with high interest rates and interest rates that went up so fast, it's going to cause problems. And that's what the World Bank is saying right here. The bank, which also cut growth estimates for 2024, said the persistent inflation and higher interest rates among the key reasons. Debt-based economy we just talked about. It also cited the impact of Russia's invasion in Ukraine and the decline in investments. Remember, if you have these investments or companies who are not yet profitable, who've recently IPO'd, what happens if that spigot turns off and no more money's coming to them? You basically got a Bed Bath and Beyond kind of situation going on. So I want to look at this chart, which we got GDP in blue and our consumer price. So I want you to notice that, the economy obviously runs in these cycles. And a common trend is that we'll see GDP and the CPI peak at the same time. And then that's usually when we go into recession or economic slowdown. See, it happened in the 1980s. We have peak in GDP, peak in CPI, and then we hit recession. Same scenario right here. 2008, we hit it as well. And then right now we're kind of seeing this trend follow suit. But I also want you to notice is what happens during these tightening cycles, especially when it has to do with higher interest rates. Of course, we're going to keep GDP in blue, and then our 30-year Treasury or U.S. government bond, which is basically controls the interest rates for y'all. And you'll notice that anytime we kind of get above this 3% level, we see GDP go back and forth, but not extensive growth. 2016, we're right here, 2017, we did decide to cut interest rates, and you can see that there is an uplift in GDP. But now that we're rising these rates above 3%, the GDP starts to come down and economic growth starts to come down with it. So this is a trend that was seen back in 2008. Before 2000, you have your peak in your GDP. Then that was followed by rising interest rates. So if that's not suggesting something, I don't know what else to present. The crisis faces development is intensifying as setbacks to global prosperity will likely persist. The economic prospect report, he said GDP in emerging markets and developing economies at the end of next year will be about 6% below the level expected on the eve of the COVID-19 pandemic. So basically, exports, imports, all of that demand is now gone. And this has to do with the interest rates, and it has to do with because we're a debt-based economy. So that's another one. The combination of slow growth, tightening financial conditions, is likely to weaken the investment and trigger corporate defaults, the World Bank said. Urgent global action is needed to mitigate the risk of a global recession and a debt distress. So this goes back into what we spoke upon earlier. If you understand the United States is a debt-based economy, companies are constantly going out getting debt to prosper and increase their returns. But what happens if that debt becomes so unattracted is that you have these companies who are relying on their investors to keep the day-to-day operations rolling. And if that turns off, you just got a bunch of zombie companies. Now, the argument for this was a lot of it has to do with back before 2008 or right after when the Federal Reserve started issuing quantitative easing. And basically, that was lowering the interest rates, spurring on more debt, and increasing the overall lending in the economy. So, what this presents itself is an issue that yes, there was probably some vendors issuing debt to these companies that shouldn't have gotten it. And what happens if that faucet turns off? Well, we got a lot of defaults, and the interest rates are not helping these companies survive. So it's a double-edged sword. What do you do here? Also, let's talk about used car prices because look, this is the inflation segment. We spoke a while back, probably about 2 months ago, regarding how used car prices have started to come down, and we said this is an indicator that inflation is going to follow suit. So used cars prices largely annualized decline in series history. Um, basically, this vehicle index tracks the auction prices of used cars, and it plunged the most on record in December from a year ago as the auto market closed. In December from November, it rose slightly to 219, but it was down 14.9% a year ago. This was the largest annualized decline in series in history. And so here's the chart of that. I spoke about it right here, said used cars prices are coming down as interest rates were taking effect in the economy. We had a series of 375 basis point rate hikes, and this is exactly what the Fed wanted to do. Cool the market. Well, they sure have cooled it, and the used car market has completely gone from an inflationary standpoint to absolutely deflation over the coming months. And then here's just another fact to argue upon it. So in our blue, we have our CPI of all urban, food, clothes, gasoline prices, etc. And then in red, we just got our CPI on used cars and inflation. So as you can see right here, we peaked probably in early 2020, mid 2020, and now we are completely back below the black line before pre-pandemic. So if we take our blue line, you can see inflation still sitting high, but this could be a leading indicator of where inflation is going. And does it make sense to keep that 5% level that the Federal Reserve has their threshold for long-term interest rates? And we'll get into that. This is the inflation data coming out as of today, December. So inflation slows last month thanks to cheaper fuel and airfares. And as you can see, we're probably about 6.5% in December, but this is and 5% excluding food and energy. So inflation is coming down. These rate hikes are working. But now is the question of when do we stop and pause these rate hikes? Because we're seeing, demand completely eviscerate. We saw it from the manufacturing data last week. So now this is the question for the Fed. But the Fed is still holding rates above 5%, and they said that for a long time. That was last week they came out with that. We're just going to have to hold our resolve. He told the Atlanta Rotary Club on Monday, said the Fed was committed to tackling high inflation, and this warrants raising interest rates into the economy 5% to 5.25 range to squeeze excess demand out of the economy. Okay, but the data is showing that demand is eviscerating quick. I believe that they were probably going to hold. We'll see in February if they raise it by 1/4 of a percentage. That's what is expected. But long time, I highly doubt that. Now, if we take the federal funds effective rate, basically where interest rates are, and then the 10-year minus the 3-month, which has to do with the yield curve inversion. And if you're not familiar, I have a great video explaining the yield curve. So right now we have probably one of the most negative yield curve we've seen in history. The bond market is saying that there's no way these interest rates can sustain these levels. And so it's just unique because this is the only time in history where we've seen such a big deficit on these yield curve inversions. So that's pretty much I have for today. Pretty good news from the inflation data. Bad news coming out from the manufacturing side as demand weakens. That being said, I hope everyone has a wonderful rest of the day. And thank you so much for watching these videos. Thank you and have a wonderful day.